Let me start by stating that central banking has become interesting and fun again. Not more than 6 years ago, it was simple and boring. In the conventional view, it dealt with one main problem, keeping inflation intact, in some cases two, add to this abating unemployment. The central bank was the main institution in the state in charge of inflation, and it had also a main instrument to achieve this, namely to set a short-term reference interest rate. We had a solid framework to work with, namely different manifestations of a flexible inflation targeting regime, and the best thing was that it seemed to work extremely well. Asset price considerations and financial stability tended to play a secondary role. But this ideal world changed substantially, and I would say abruptly, in 2008 with the well-known financial crisis that started just a few blocks away from here. Advanced economies entered into a major crisis that in a way is still not fully over. Given the economic, financial, and political implications of the crisis, central bankers in advanced economies have played a stellar role in the crisis resolution process, a role that for some experts have overextended or overburdened central banks. Oftentimes, you still hear in some regions and countries that they are the only game in town. All these events certainly have had an impact on emerging market economies. It is true that during the crisis, emerging markets have in general performed well. They have proven to be resilient based on strong fundamentals. We have merits, but at the same time, we should not ignore that we had experienced during this time, for most part, with two very positive external shocks, namely, very high commodity prices, and second, abnormally low external interest rates in the context of abundant liquidity. This led to very rapid economic growth. But we seem to be facing a turning point this year. The life of rapid economic growth induced by high commodity prices and plenty of liquidity seem to be coming to an end. So the question is, in this new world, what are the challenges that emerging markets central banks face, and what should be their response? Given our mandate, a tremendously important aspect is the fact that advanced economy central banks are in the process of starting the normalization of their monetary policy stance. That for sure will imply a more constrained liquidity and higher interest rates. So the first challenge, not to drop the ball as we pursue our main mandate of keeping inflation under control. In emerging markets, it's relatively easier for inflation to spin out of control, even though most countries in this category have autonomous central banks. But these institutions are young, with enhanced but fragile credibility. So the challenge is to resist the pressures not to be overburdened with multiple mandates, in particular, to play a very active role in applying counter-cyclical monetary policies. Counter-cyclical monetary policies should be applied as you drink tequila, in moderation. Second challenge, financial stability is a precondition for a conventional, simple, and effective monetary policy. The question then is, how do you assure this precondition? Since the late 90s, most emerging markets have adopted appropriate financial sector supervisory and regulatory regimes, and we have kept up to speed with the adoption of the new international standards in this regard. But unconventional monetary policies in advanced economies have generated massive and oftentimes volatile capital flows in and out of emerging markets. An important fraction of these flows have been relatively stable, as they have been induced by the medium to long-term growth prospects of emerging markets relative to advanced economies. But not a negligible portion is short-term oriented and is jittery, mostly carry trade type of transactions. All these flows have affected the level and volatility of domestic interest rates, credit, the exchange rate, both in nominal and real terms, and have made the implementation of monetary policy extremely difficult. Some of these flows have been intermediated by local banking systems in emerging markets, and some in the bond and equity markets. From a financial stability point of view, the ones of most concern are the ones intermediated by the banking system and the fixed income markets. In the first case, excess liquidity have led, in some cases, to asset price bubbles in housing, representing a vulnerability for the banking system. In bond markets, the spillover effects of unconventional monetary policies have manifested themselves in very rich prices, excessive spread compression in some cases, overdone risk-taking by some investors as they search for yield in new frontiers or in covenant-light and high-yield emerging market corporate bonds. The unwinding of these investments could be a source of significant turbulence, as we saw recently in last May and June. All these inflows have also generated, in most cases, important nominal and real exchange rate appreciations that are not in line with long-term equilibrium. And needless to say, they have had real effects in emerging markets, slowing down exports and economic growth. This is a way to shift part of the adjustment from advanced economies to emerging markets, some of it being understandable and can be tolerated, but some is excessive. As you can imagine, this scenario has represented a real dilemma for emerging market central banks. On the one hand, given our past history of external capital deprivation, we tend to be conditioned to attract as much capital as possible. On the other hand, too much capital in a short period of time can generate major damage to the economy, given the limited capacity to absorb capital. Responses have varied among emerging markets. Some have allowed only for market adjustments, like in my country, Mexico. Others have intervened heavily in the markets, especially in the foreign exchange market. And in not a few cases, macroprudential policies have been attempted. I would venture to say that the field of macroprudential policies is a promising one. Reasons. First, it's an additional instrument to pursue an additional objective other than inflation, which is basically financial stability. Second, it should not interfere, and it does not interfere most of the time, with monetary policy, i.e. it should be a complement, not a substitute for it. At the same time, this new policy field has also some problems, like its definition and content, which is not clear. In many countries, it's not well defined who is in charge of them. And also they have been used or abused to pursue objectives like competitive currency manipulation or protectionist measures. My suggestion here is that the international community should develop, in quotation marks, best practices in this respect, and that whenever possible, central banks should be entrusted with their management, drawing a clear line with monetary policy actions and following the principles that macroprudential policies should observe. They should be transparent, targeted to specific market failures or externalities, and preferable, they should be transitory. So wrapping up, in the case of rapid capital inflows, emerging market central banks should, first, as much as possible, preserve the single objective of monetary policy, allowing market adjustments to take place, unless non-equilibrium adjustments that could threaten future financial stability take place. And second, if such non-equilibrium adjustments is a possibility, use transparent, well-targeted, and transitory macroprudential measures. Now, moving to the third challenge, which is not unrelated, I have to say that the recent problems facing emerging market central banks, especially since May, June of this year, has not been capital inflows, but capital outflows. These have generated, in some cases, market responses that were more violent than the ones we saw after the Lehman collapse in terms of exchange rate volatility and long-term interest rate increases. An important point here is that, by and large, markets have differentiated among emerging markets. Those with better fundamentals and no vulnerabilities fared better since May 2013. So what is the main lesson here for emerging markets? Today, it is a must to have a strong external position characterized by a low current account deficit, large international reserves, long duration in the external debt, and if possible, contingent international financing like Mexico, Colombia, and Poland do through the IMF flexible credit line. To have also a flexible exchange rate in combination with a flexible and credible inflation targeting regime is important. Finally, there is also a premium for conservative fiscal policies and having a public debt whose sustainability is not in doubt. Even with these elements in place, as unconventional monetary policies in advanced economies are unwinded, domestic interest rates will increase and it can become turbulent. The only adequate response for emerging markets' point of view is one that is comprehensive and consistent, involving fiscal, financial, and monetary policies. Needless to say, central banks cannot deal with these situations by themselves. To overburden central banks with the defense of financial stability in the face of massive capital outflows itself could be self-defeating. Finally, let me deal with the not less important issue of economic growth. It has slowed down recently in emerging markets due to, first, the slowdown in advanced economies. Needless to say, there is no decoupling. And second, some complacency by some emerging markets that did not pursue productivity-enhancing structural reforms in the good times. Again, in this front, monetary policy cannot do the job of starting and sustaining rapid economic growth by itself. Therefore, many emerging markets have some catching up to do by legislating and implementing structural reforms as fast as possible. Mexico is right now in this process. Let me conclude with the following consideration. The IMF estimated recently that 2/3 of spread compression in emerging markets since 2008 is explained by external factors. These external factors are and will revert. If emerging markets want to preserve as much as possible such spread compression, they should first reinforce their macroeconomic fundamentals, keeping the central bank concentrated in keeping inflation intact and playing a leading role in the design and implementation of macroprudential policies. Assuring this, also it's very important to assure the sustainability of its debt and upgrading the regulatory and supervisory regime in the financial sector. and sector get going with structural reforms that will make them more competitive, will allow them to increase their potential rate of growth, and make them less dependent from the world's business cycle. Thank you very much.
Thank you so much. Have a seat. Thank you for that masterful overview. Listening to you makes me think that the emerging economy central banks are the bastions of orthodoxy nowadays. Have a seat. I'm going to open the floor to questions in just a second, but I just wanted to pick up a couple of the things you said. First is I love the idea of counter-cyclical policies like tequila, only a little bit, in moderation.
Yes.
But you framed your remarks that we are in a world where there is an exit likely from unconventional policies in the rich world. Let me just ask you for a second, what happens if that's actually not the case? If we're in a world of prolonged unconventional policy, how does that change your calculus in the emerging world?
Well, as you notice from my remarks, I placed in the same speech both as challenges the inflow and outflow of capital. So precisely this reflects the uncertainty that we face of when the tapering will take place and when other central banks might normalize their monetary policy stance. So, I mean, we're in a situation, in a very difficult situation, that we don't know the nature of the game. Will it be capital outflows? Will it be capital inflows? I mean, I asked Jaime Cortina, my colleague who is here, who is in charge of our desk, what type of day is today? And oftentimes he doesn't really know. And this is not to criticize him, but this is the nature of the world we're facing today. So we have to be prepared for both types of scenarios. I think that as we wait for the normalization process, I think we should put as much gravel in the road for capital inflows. And the idea here is for this to be done in a non-distortionary way. And
by gravel in the road, you mean capital controls of some sort?
Gravel means something that makes them less rapid, less abrupt, more thoughtful. Not necessarily capital controls. No.
Taxes?
No. For example, letting the market work sometimes work very well. You know, I mean, for example, if countries think that the currency is cheap and it appreciates, that is part of the adjustment, and that would slow capital inflows. Obviously, many countries try to resist this type of adjustment. Not all of them, no, but that's a possibility. Now, if that is not sufficient, then you can start to intervene in the markets, like increasing international reserves, like doing some type of controls, yes, to capital inflows. In some cases, as I made it clear in my presentation, you have to differentiate among the types of capital inflows that you face. It's very different if those are intermediated through the banking system or to the fixed income markets. If the problem is in the banking system, then, you know, some type of actions like increasing the loan-to-value might be adequate.
Are there any questions from the floor? Yes, gentleman right here.
Hi, Governor. González Parmo, BBVA. Just a question from your remarks. It seems that you have not much hopes in international cooperation. Where is the G20, IMF, or Basel? Do you have any hopes that they could become part of the solution?
Well, all the time when I come to this type of events, the most difficult questions come from fellow central bankers. And we have here a very brilliant ex-central banker. Here, let me refer to a quote by a very famous economist, Anne Schwartz, that used to write with Milton Friedman. I come from the University of Chicago, so I'm familiar with this literature. And in one of the rare papers of Anne Schwartz, she said words in, I mean, I'm not quoting literally, but she said that cooperation is a fair weather phenomena, which means that we like to cooperate, we like to get together, we like to make agreements, everything is nice and dandy when we do not need cooperation. But when things get tough, cooperation is extremely difficult. So I fully subscribe to her view. That doesn't mean that we shouldn't try, but in very difficult periods of time, you run very quickly into situations where national interests conflict with a broader international purpose. So we should try it, we should keep going. At least enhancing information is very, very valuable, but we should not count on the international community to come with a solution that will satisfy all countries.
Thank you. Any more questions? Yes, Greg.
Governor, you talked about the importance of the contingent credit line from the IMF as being an extra bulwark against capital outflows, but it's noteworthy that Mexico, Poland, Colombia are the only countries that availed themselves of that facility. Other countries still have a stigma about going to the IMF. And secondly, the IMF itself is somewhat constrained in its ability to play that role because notwithstanding global agreement to increase its resources, that agreement has not come about, partly because the American Congress doesn't want to increase the quota. In your view, how much of a concern is it that these problems of governance at the IMF in terms of offering the necessary cushion that the emerging markets need for the against the type of violent swings in capital inflows and outflows that we've seen?
Well, first of all, I think stigma is something that I think is overdone. And we have been a client of the fund in good and bad times. And for us, it has worked really well to subscribe the flexible credit line because in a way it has been sort of a sort of seal of quality on our policies. It basically means that the fund considers our macroeconomic framework as an appropriate and solid one, and that therefore they are even willing to commit resources without conditionality. And I think that is very, very powerful. And that's something that you can certainly get a lot of mileage politically in your own country and also externally in the markets. I think that you're right. The fund needs to get moving with enhancing its lending capacity. And it should be done mostly, the fund should be mostly quota-based institutions, so the quota revisions are essential.
Why do you think if it's such a good tool, only 2 countries have availed themselves of this?
So only for countries?
Why if the fund is such a good institution, why haven't more countries done what you've done in Mexico, which is to have this contingent credit line? Why has it been a less popular choice amongst other emerging economies?
Well, I think for considerations like what Greg said, I think for the stigma, I think to go to the IMF oftentimes have been, and most of the time, 99% of IMF interventions has been in cases where countries are in deep trouble. And so the fund is associated with rescuing basket cases. The flexible credit line is the first effective workable tool that the fund has to reward good performers. So I think that markets should notice it, markets should recognize it, credit rating agencies should recognize it, and more than anything, countries should get going with this. In private, I have heard from many countries in the last 5 years, oh, we should have done what you did. But, you know, now when the going is tough, they fear that they might not qualify. So to enter into this type of arrangements is much easier when you are doing well and you really are taking a foresight, preventive, prudential measure.
Thank you very much. One very brief question? No more. I think we better leave it there then. We're running out of time. Agustín Carstens, thank you very much indeed for a terrific overview of the challenges you face.
Thank you very much. Thank you.
Bye-bye.